Kia ora, morena, everybody. Welcome to the launch of the Aotearoa New Zealand's Responsible Investment Benchmark Report for 2023. Tēnā tātou katoa, ko Dean Higati taku ingoa no whakatoa hau, he papa hau, ko te whānau taku tuatahi. Ke tauira hoi te ao Māori e ngāre me mehe ka tika, ke ngā tangata whenua o tēnei rohi. E ngā ke nui anō, ki tēnei mahi, ki tēnei kaupapa, tēnā tātou katoa. Kia ora, everyone. I'm Dean Hegarty, Executive Manager at RIAA, head of the Aotearoa New Zealand branch, and I'd like to start by acknowledging the traditional custodians of the land I'm on, Ngāi Tahu, and extend that acknowledgement to all of the different lands that people are joining us from today. So, look, the reason we're here is to launch the benchmark report. This is a really foundational piece of research for RIAA and for this industry, where we measure and map the size and the growth, the trends and the performance of the RI sector. And this research comes at a really critical moment in time for us. I think we're all seeing that the rate of change we're experiencing is staggering, and this changing legislative landscape and climate-related disclosures, investor demands and expectations are accelerating, performance pressures and increasing focus on greenwashing, and all of these pieces are constantly moving. So the purpose of this report and today is to really provide us with some solid metrics that can ground us and provide a really clear, quantifiable insights into what's happening, as well as data which will serve to demonstrate just how far RI has come in being a mainstream part of the investment landscape. But we also really want to make sure that we're underlining just how important it is as a fund manager or as an advisor to be actively working to advance in this area. So before we dive into the research, I just wanted to start with a little bit of context to launch us. This is the 19th year that RIAA has published a report specifically profiling the New Zealand RI market. And when we're moving at such speed, it's really easy to lose sight of how far we've actually travelled. And so I thought I'd start just with some numbers to help quantify that. And so to give you a sense of that journey, when we were analysing the New Zealand RI market in 2003, what that actually looked like was us analysing what were at that point in time the 4 ethical investment options that existed in the New Zealand market. So those 4 options covered a combined total of $19 million in assets. And again, just to take you back to that time, there was a newly formed government entity that you've probably now heard of called the New Zealand Superannuation Fund, which had made its first ever investment of $2 billion in October that year. And so just also a quick shout out to the author of that work, Roger Spiller, who is still doing the mahi in this space today and is also joining us online for the call. So kia ora, Roger. To move from there and then fast forward 10 years to 2013, that $19 million in assets had grown to $1.6 billion in what assets that we called core RI assets under management. So those numbers are really important, just as a reminder of where we've come from. And I want you to kind of have those in the back of your mind as we go through and look at some of the numbers that we are working with today when we look at the scale, but also the growth of this market. Because while today is about understanding where we are and also where we're going, it's equally important to understand exactly where it is we've come from. Some thank yous before we launch into this. This is a huge piece of mahi. It relies on a really wide range of contributors. So we're really fortunate to have a couple of really key partners to this report, PIMCO Asset Management and Australian Ethical, as well as our research provider EY, all of whom have played a massive role in bringing this report together. Also just want to say a quick shout out to all of the RIAA members who support us on an ongoing basis in allowing us to provide this work to market, but also and especially to those of you who have taken the time to contribute your data to help us bring these findings together. So we're going to start with a run through of the key results from my colleague and RIAA Research Manager, Dr. Zsuzsa Benhalmi-Zakar. And Zsuzsa's got a wealth of experience in sustainable finance in both the public and the private sector. And then we'll move on to a panel discussion where we'll then look to unpack some of the results and really dive into what they mean, how these findings can provide really critical reference point to where we are, but also obviously where we need to go. So I'll now hand you over to Zsuzsa to highlight some of the key findings. Kia ora, Zsuzsa.
Good morning, everyone. Good morning, Dean. Good morning, panelists and attendees. It is my pleasure to present you with the New Zealand benchmarking report for 2023. I have about 20 minutes to run through pretty much the key findings of the study, which is where my presentation is going to focus on. I will bring in some sort of smaller details or just to make it a bit more interesting and to provide some background on how we get the data and what the data might mean. I also want to encourage you to access the report, which is available on our website. All our research is available on the RIAA website under the research tab, and it's free to download and read and utilize and reproduce any part of it. If you have any questions about any details, you can pop them in the chat, and if you have any specific bigger questions or issues, then feel free to email me. Okay, let's kick it off. So first of all, we have we have three really big tables in the report. One is on, basically summarizing or drawing out the New Zealand key developments. The other one is drawing out on global or international developments. And the third one is about Australia. So I didn't want to put in the Australia because we have a whole report. We already launched on Australia, but just bear that in mind that the two markets are operating, some of the players operate in both markets is what I'm going to say for now. So first of all, we have the New Zealand developments, and I really just pulled out some of the key things that have been happening. The XRB, a lot of activity around climate change standards and disclosure, and we see that that was really a hallmark for 2022. We also had launch of the New Zealand Stewardship Code, and we had rolled out the signatories in 2022, so that was a key development as well. From our perspective, I think what is important to bring out is that the Financial Markets Authority requires default KiwiSaver funds to exclude fossil fuels and certain illegal weapons. And so as we go through, just bear that context in mind, because I think it really makes sense in light of the data that I'm going to show. On the global side, again, huge efforts and advances on climate change. Interestingly, we have a lot of activity still continuing in the EU around sustainability reporting, taxonomy refinements, and so forth. We have what we really anticipate is going to be a big change is the International Sustainability Standards Board's work on setting those international standards. We also had the International Standards Organization release a net zero guidelines, and the US Inflation Reduction Act, which was sort of a momentous occasion in the US. The work on the TNFD continues, and there were several beta versions and piloting and presentations around there in the region over the past year. So moving on to the next slide then, I just wanted to show you, this is sort of a hallmark slide that we show each year that it summarizes the methodology, also our definitions and just how things are calculated. So it gives you a bit of clarity as you read through the report. So the biggest part of this sort of pie is the total managed funds, which is 352 billion. The research universe, which is all the investment managers and asset owners that we cover, is at 261 billion. And then within that, we have a responsible investment asset under management part, which is really what we call our RIAA, the real responsible investment volume, that's at 183 billion. The way we collect the data is a combination of survey respondents and desktop research. The research universe this year was 70, which is a pretty big research universe. 24 of those were survey respondents, another 24 were desktop research respondents. The remainder are international or Australian-based investment managers that contribute to the responsible investment or the total managed funds market of New Zealand. So New Zealand is pretty unique or different to Australia in that way, that we have a large volume of contributions from Australia and internationally elsewhere. So the 48 are New Zealand-based investment managers and asset owners. So the key terms here are responsible investment leaders, responsible investment assets under management, and then the research universe and survey respondents. So that's the definition methodology. The next slide is really where all the numbers come together into this total responsible investment market and how that relates to the total market in New Zealand. It is, I think this should be more like a celebration because it's quite the landmark that we're crossing here, I think, in New Zealand or for our region. For the first time this year, over half of managed funds in New Zealand are managed responsibly based on our definition. And that's at 52%. It's a record number at 183 billion compared to 179 billion the year before. This is also impressive considering that the total managed funds market actually shrunk in New Zealand slightly due to, less than ideal sort of market forces, I suppose, and all the external issues that have been going on globally. So it's a new record. I also wanted to highlight that the full fund holdings disclosure reached 73%. New Zealand has regulatory requirements around full fund holdings disclosure. So, I would have expected 100% there, but I suppose this might be around interpretation as well as some of the exclusions and the international players' contribution. So an amazing numbers here that we're seeing. Next up is a slide that portrays the performance of responsible investment and RIAA certified products. So here what we see is we have 3 categories: managed growth funds, international share funds, and Australian share funds are our 3 main categories. This is an aggregate it's an aggregate number. At the moment, we don't separate New Zealand and Australian certified funds because we don't really have the numbers, but we're hoping that for next year, we'll be able to separate those 2 out and offer you a much better insight. At the moment, the performance is for certified funds. RIAA certified funds is on par or better than the relevant benchmarks. Moving on to the next slide or set of slides is the responsible investment approaches. So here, what we see are the 7 categories of responsible investment approaches as defined by the Global Sustainable Investment Alliance. And we've been using this categorization for a number of years to align with our global partners who are also using this as well. So it's pretty set, the definitions are set, and what we find from our survey respondents is that for the first time, corporate engagement and shareholder action is on top, followed by negative exclusionary screening and ESG integration. So those 3 approaches are used across investment managers across the fund by and large. Then we have significant growth in norms-based screening. We'll talk about that a little bit more in detail. We also have sustainability themes investing that appears to have shrunk over time, and positive or best-in-class screening that has gained some momentum, as well as impact investing. So that's how it shaped up this year based on survey respondents. Moving into more detail, corporate engagement and shareholder action, so the biggest piece of the pie. What we see is that we have a number of survey questions and desktop questions that we go through here. What we see is the climate change themes are dominating in the corporate engagement arena. But do note on this slide, on the figure, the wide range of different topics that investment managers are engaging on with investee companies. So while climate change is at 14%, we also have human rights, biodiversity, geopolitical issues, blue economy, natural capital, a whole raft of different issues that over the last 12 months, investment managers engaged on. Another set of questions ask about the extent of reporting on corporate engagement activities, like what do you do as part of your corporate engagement, and the outcomes of those activities. What we find is that 40% of our research universe reports on activities and outcomes. That's up 2%. You have 23% that report on either activities or outcomes. That's down 3%. And we have about roughly a third or 36% that do not report on either of those. So there's no change there. So we would really anticipate or like to see this increase. We would like to see more transparency and more reporting on corporate engagement activities and outcomes as a result of the New Zealand Stewardship Code, but also as a result of just some more resources spent on preparing these reports. Next up is negative screening trends. So this is a little bit of a busier slide, so I'll take you through it. So on the right-hand side, the figure compares the proportion of investment that excludes certain sectors or activities compared to those that New Zealanders seek to avoid when investing. So this data, the last part of this data comes from the Voices of Aotearoa, which was launched in early 2023. So this is a consumer study. So we basically ask consumers what it is that they're interested in avoiding or supporting when they're investing. So there are a couple of slides that will draw on that data. What is interesting to say here or to compare is what is actually being screened, what topics are being screened. So wherever you see the green bar, that is what's being screened. And wherever you see the orange bar is where the population thinks that they would like their investment to avoid support for those issues or sectors. So there's some overlap in some of these areas: tobacco production, fossil fuels, human rights, and labor rights, all weapons, adult entertainment, fossil fuel generation, and gambling. But there are a whole raft of issues that are currently not either marketed or not being screened. These are GMOs, animal testing, intensive livestock management, certainly around meat products. It's an issue, social media companies, and so forth. So there is an opportunity to perhaps look at what it is or use the data on what consumers would like to actually see this and make improvements in your product's disclosure. So the top exclusions by assets under management. So 99% of negative screened AUM excludes tobacco. Fossil fuels made huge gains, obviously impacted by the KiwiSaver default requirements and possibly other factors as well. Nuclear weapons was a new category we introduced. Controversial weapons are also high. And then come sort of these other issues that are about 50% of AUM is being screened for: human and labor rights, and countries and zones with government integrity issues or corruption issues. Next up is ESG integration trends. There's growth in the overall coverage of ESG integration, but I believe over the last, at least couple of years, it has remained relatively stagnant. We see a larger increasing proportion of investment managers apply ESG across the majority, if not all, of their assets. So ESG integration has spread, but there's still a 13% or so that do not apply ESG integration at all. This is similar to actually what we see in Australia, except that the proportion is a bit larger. And I suspect that impact investors and some of the boutique or smaller firms fall into this category that have a clear impact mandate or focusing on, sort of more of a sustainability focus. And they might not view ESG integration as part of their ESG policy, but look for other approaches that are more suitable. Norms-based screening is the fourth most common responsible investment approach applied in New Zealand. We had a very small amount last year, around 16 billion, and now it has gone up to 125 billion. It could be a little bit of an impact of reclassification, perhaps, due to regulatory or the introduction of regulatory requirements, or people just instead of negative screening, sort of putting it into norms-based screening or refining their definition. So just bear that in mind. But all in all, I think norms-based screening is emerging in New Zealand as sort of the next big approach to use, and the next place where ESG practitioners are turning to when they're looking to enhance or improve their responsible investment practices. The two orange little arrows I put in there just to show you, those are the two climate-related norms, the Paris Agreement and the TCFD, so the Task Force on Climate-Related Financial Disclosure, which wasn't really present as a factor last year. But there are a range of different norms that are being used to screen investee companies. Next up is the trends in sustainability-themed investments. So now we're getting into those approaches that cover a smaller proportion of AUM. The next three approaches, starting with sustainability-themed investments, tend to be used only at the product level. So rather than rolling them out fund-wide, it's something that is applied to specific responsible investment or ESG or sustainability labeled products. Again, we see climate themes dominate, but we also see other, I think, very encouraging activities around investments in waste-related companies, transport, sustainable transport, natural capital themes are emerging. It's a bit disappointing, I suppose, to see social themes trail behind. It would be really great to see that, in addition to looking for that, obviously this is an area where people are looking for opportunities to produce a return, and to see social issues also incorporated into the sustainability-themed approach or screen. Interestingly, sustainability-linked loans, and I wanted to put it in there, dropped. At least we weren't able to identify more than 735 million in sustainability-linked loans in 2022, although in 2021 we had a much larger fraction. Positive screening, a little bit different to sustainability themes. I often get questions around what the difference is between the two. The definitions are quite clear, but what we see is positive screening mostly focusing on more sustainable companies or ESG leaders. Now, I put the orange arrow in there just to remind myself as well, not only that there was a drop compared to last year, but also that ESG or more sustainable companies and ESG leaders are, that approach is not, it's not used in New Zealand as much, but in Australia, we actually saw a huge growth in that. So that was an interesting sort of different. I put little thermometer symbols around the climate themes for positive screening, renewable energy, non-energy climate change solutions and adaptations coming in at number 2. That's very interesting to see. I'm always interested in adaptation and finance for adaptation, but we also see transition risk management and physical risk management being targeted. The last of the approaches is impact investing. This is a small but really impactful and powerful category. We do see an impressive growth from 8 billion to 11 billion this year. They're mostly, the bulk of the impact investing is made up of green, social, sustainability, climate bonds. I also introduced there some CARI bonds, but we also have some impact funds, and thank you to all those survey respondents who filled out, who are active in impact investing, actually provided us with details on the targets and the outcomes. So I just put a few examples in there. Where do these impact investing dollars go? 710 million in conservation, environment, and agriculture, really impressive. Another 200 million more in physical assets around affordable housing, job creation, and training. The last part of the survey asks ESG practitioners about their perceptions around key drivers and deterrents for market growth. So the key drivers, so what I had put left in black, they didn't change. So the top three key drivers remain the same: demand from retail investor, growing interest by investors, and acceptance that ESG factors impact financial performance. Anything that has moved up among the drivers is marked green. So the desire or need to drive social benefit has increased in importance. Expanding notion of fiduciary duty to include ESG consideration, inclusion of ESG in risk management processes. I think these are all sort of the starting blocks of the alignment with the XRB and some other expectations and international initiatives and commitments. Key deterrents, there was a lot more movement in key deterrents in this year's survey. So we saw that lack of awareness of responsible investment by the public and mistrust and concern about greenwashing jumped to number 1 and number 2 and increased in terms of concern. Performance concerns didn't move from number 3, but the lack of viable products and options did move up. So as well as the lack of qualified advice and lack of legislative requirements have increased. So the last 2 slides is where we announce and showcase the responsible investment leaders and responsible investors. So congratulations to the responsible investment leaders for 2023. These are the organizations that scored in the top 20% of the research universe on our responsible investment scorecard. This is a more strict and a new way to defining leaders that just showcases really that top level or that high leadership. And the second slide shows the responsible investors for 2023, which are the organizations that received at least 15 out of 20 on our responsible investment scorecard, which is in line with the methodology we've been using for a number of years. This is also incredibly difficult to achieve. So congratulations to these organizations and for those that work there for their responsible investment efforts. And I'll hand it over to Dean then.
Thank you so much, Ruja. And again, congratulations to those who made the leadership status again for 2023. So look, lots to unpack in that, and as Ruja mentioned, really highly encourage you to make sure that you get in and download the full report, which will allow you to unpack all of the nuance that sits in behind those key findings. You should all have a copy of or a link to that, which would have come into your inbox, and we'll send out some follow-up data after this. So I'd now like to move and introduce the wider panel for kōrero on these key findings. We're really lucky today to have a really good spread of expertise, as well as geographical perspective, which is going to be really unique and really interesting today. So firstly, Pip Best, who is the Partner of Climate Change and Sustainability at EY, is joining us from Auckland. Leah Willis, the Head of Client Relationships at Australian Ethical, joining us from across the ditch in Sydney, and Lorenzo Brunelli, who is the Vice President at PIMCO Asset Management, and is joining us at London, where it is extremely late in the evening. Thank you very much for hanging around with us, Lorenzo. Kia ora to all. So I'll be running through a number of questions with the panel. We do have a Q&A function. There'll hopefully be some time for us to get to those. So if you've got questions already, or as they come up as the discussion moves through, definitely encourage you to jump into that. Into the Q&A function. We'll do our best to answer those as best we can. I'll try to multitask, although it's not my greatest strength, but usually will also be answering any sort of specific data-related questions as we move through. So I think there's lots of really interesting things to unpack here, but it'd be good, I think, to start at a top line level. I think for me, it was really fascinating to see that even though, I know we've been seeing standards rising really quickly, and the expectations about what demonstrating leading practice is becoming more difficult, and expectations of the market are growing. In spite of that, we've actually seen responsible invested assets are growing and have now exceeded more than half of the market. But I know EY in particular have been heavily involved in compiling the data for this. What's your view on these findings and what they can tell us about the RI market in New Zealand?
Thanks, Dean. I thought I'd just put in a couple of points that probably was seen in the data side of things that probably haven't come out in the presentation so much. So probably firstly is the point that you just touched on, Dean, which is actually the expectations of being a leader in responsible investment are increasingly increasing. And we do see that bar is getting higher and harder to meet. So that's the first point. The second point, which I'm sure we're probably going to discuss a little bit more, is the increasing global focus on greenwashing and what the impacts of that mean to the responsible investment market. So although we're seeing what classifies you as a leader increase, we're also seeing, I guess, that the transparency and honesty in what you're doing becoming increasingly important, which is almost a bit of a pull factor in a way, because it actually means that, you know, every claim you're making, that we're seeing, I guess, higher expectations of what needs to sit behind that. And I think probably we'll delve into that a little bit more deeply, I'm sure, at some point. I guess the other part that we didn't really touch on, and again, we might talk about this a little bit more later on, is that so we obviously, this is the New Zealand report, there's the similar Australian report, and the AUM number in Australia fell, which I think is quite interesting, and potentially for New Zealand might indicate two things. One is potentially the different part of the maturity curve that we may be at versus Australia. And secondly, probably linking it back to that greenwashing point, we've obviously seen ASIC we've seen ASIC probably a little bit more than the FMA be active on greenwashing, particularly in the responsible investment market, and that potentially having implications to what is classified as responsible investment. So I'll start there, and yeah, I'm sure we'll delve into some of these things a bit more.
Yeah, thank you, Pat. Leah, I guess that's a great segue to you. You obviously operate in the Australian market, but also have a lot of exposure to New Zealand, and you were involved in both reports. What were which of the findings jumped out to you?
Yeah, I think there was a real similarity that I drew between both reports, and I commented on in the Australian webinar as well, is that rise in corporate engagement and shareholder action as now the most significant approach used by investment managers. Ahead of negative screening now and ahead of sort of ESG integration. And we think that is the maturing part of the market, that ESG integration is not enough. Investors are expecting more from managers. They're wanting a higher level of engagement with investee companies and across, you know, critical issues that they might be able to drive change in either corporate behaviour or across sectors themselves. So we think that might be driving that sort of increase in corporate engagement and shareholder action, that they're kind of being used together as different tools to achieve different outcomes. Obviously, we have a really long pedigree in ethical investing, and we see engagement with investee companies as being a really critical role for any RI manager to make sure that they are being active owners and stewards of their investments, but also being able to drive that change in behaviour and standards. What surprised me most in both reports is the lack of transparency and reporting and disclosure still. It's still quite low, even though there's this huge number, particularly in Australia, of public commitments to RI. There's lesser that are now sort of obviously meeting RIAA standards, but then even lesser again, I think it was only sort of 40% of respondents are reporting on both engagement activities and outcomes. So I think we've moved in terms of investor expectations, engaging behind closed doors and not being open and transparent about the change that you're trying to drive through your engagement, I think is a really critical factor. And I think that transparency is leading to a lot of those client concerns about greenwashing. And the only way to really address that is be more open and communicative and full disclosure and transparency.
Great, thank you, Leah. Lorenzo, I might go to you, and absolutely, it'd be really useful to, and we will unpack that engagement piece in more detail. But before we do that, yeah, PIMCO operates in a really unique spot. You're obviously in a very global role, Lorenzo, but PIMCO's got a huge amount of exposure and does a lot of work with asset owners in New Zealand. You're obviously also sitting in the fixed income space. What part of the findings jumped out to you the most?
Thank you, Dean, and good evening, everyone. So, yeah, we found quite surprising, to be honest, that the biggest barrier to growth of responsible investment strategies last year was the lack of awareness of these strategies by investors, while that was not actually the case in 2021. And the jump is also quite noteworthy. If you think about this 18% jump versus 2021, after actually previously dropping significantly, a 30% drop roughly between 2020 and 2021. And really, the RIAA report points to a number of reasons for this large drop last year, including the potential overestimation of the investors' awareness in previous years compared to 2023, so today. However, these, from our perspective, might have happened also because of the increase in relevant standards, increase in regulation, best practices, and recommendations, just to name a few. Essentially, a material increase in the complexity of this market. Whatever the reason, from our perspective, as time passed, we have actually seen notable improvements in the investors' understanding of responsible investing globally. So if we take one step back and we look at the global picture, we believe that the overall understanding has improved. We believe that the overall improvement in market standards and in the disclosures is likely a significant driver in this trend. And quite interestingly, from where we sit, we can say that today investors look for more custom and targeted sustainability strategies in areas such as GSS, Green Social Sustainability Bonds, the SDGs, the Sustainable Development Goals, or decarbonization, just to name a few. We would also argue, looking at the findings of this report, that another big surprise, a positive surprise in the RIAA report, was the dramatic drop in respondents citing the lack of investment options as a barrier for responsible investing. We're not necessarily surprised about the direction of travel here, but more about the magnitude of the change compared to the previous year. So this was the largest barrier in 2021, but it now seems that the asset management industry is really coming to the market with thoughtful solutions to address most of the investors' sustainability objectives. And for example, there is a recent Morningstar report that noted numerous fund launches which target relatively nascent sustainability themes, including nutrition, including social fairness, for example. And from the conversations we're having with our clients, that again, the investor sophistication is certainly increasing. Their objectives are becoming more nuanced, which we think may spur actually continued growth in viable products in the market, accommodating a range of sustainable investment themes going forward.
Really interesting, Lorenzo. So it's interesting, I think, when we look at all of those answers, intertwined through all of them is this theme that we're seeing, which is really maturity and a maturing and advancement of what we're doing, right? And so a lot of these pieces are all impacting each other where, it was historically, there wasn't a lot of great options to invest in. Now that's no longer a problem. And as a consequence of having a lot more options, we move to greenwashing becoming an issue. And then as, that obviously gets the regulators involved. I'd love to get your insights into that maturity. What do you see as really driving that? Is it something that's coming from investor demand? Is it being driven by the legislation? Is it all things all at once, all of the time? Maybe Leah, maybe can we start with you?
Yeah, sure. And I think there's a lot of different factors that are combining to grow the opportunity set for RI at the moment. There's no doubt that global standards and legislation is pushing fund managers to dig deeper, to consider We've had the climate sort of disclosure. We've now got nature disclosure. So really being pushed to think a lot deeper about their investment decision making and the impact of those investment decisions on the world around us, not just from a financial perspective. So no doubt that's a factor in delivering momentum and growth in this space. I think, then there's no doubt investor demand, right? We see all of the surveys that come out in Australia and in your own consumer benchmarking in both New Zealand and Australia that investors are demanding more RI considerations. Their expectations are growing of managers, but also they are moving from these blunt exclusions through to having or wanting to have a more positive impact and wanting to see positive outcomes that are actually driving capital to a more sustainable future. So no doubt that is sort of broadening the scope of how investment managers think about RI. And then I think the biggest thing for me, and I guess it's probably more of an Australian and global perspective, but the greatest driver of change will be the transition to net zero. Companies and whole sectors, particularly here in Australia, us being such a carbon-intensive market, we need to undertake so much change and the huge amount of capital that needs to be deployed over the next decade. And quite revolutionary in terms of the US IRA, so the Inflation Reduction Act, $400 billion to support new clean energy infrastructure, and then the recent federal government budget here in Australia with another $25 billion to upgrading our electricity grid and going more sustainable and green and clean. So that amount of capital is going to continue to push new investments, alternative investments to the ones that investment managers have been making for the last couple of decades. And I think it will fundamentally change the way we look at, particularly here in the Australian marketplace. Entire companies will change business models, and there'll be new clean alternatives that will emerge in terms of offering investment opportunities.
And maybe it would be good to get some insight from you, obviously, what makes New Zealand different to Australia, or what makes it really relevant to New Zealand is that so much of our capital ends up invested in the ASX, which obviously is, as you say, Leah, is a really carbon-intensive or full of a lot of carbon-intensive organisations. New Zealand's, I suppose, carbon spread is so different, being really with our economy being so agriculturally focused. How do you see those things, all those drivers operating from a New Zealand perspective?
Yes. Sorry.
Sorry.
No, go Pip.
I don't see it being too different to what Leah said. For kind of the reason you just touched on, Dean, which is, New Zealand investors are exposed to the global economy, and this is the global transition. I think it's exactly as Leah said. We're seeing that net zero transition start to be recognised as being, I guess, very material to investment returns and future opportunities. And with that, we're seeing knowledge resources increase in this space. And I guess with that, and that's probably on the kind of in the funds management space, but also in the consumer space, the knowledge is increasing. And I think that knowledge and the recognition of the speed of the change that we are requiring to meet that net zero aim is I guess potentially one of the key drivers in terms of the change of the RI approaches, which I think, Dean, was your question at the outset. So we're moving from ESG integration, which is potentially like a kind of can maybe be, or used to maybe be, tinkering at the edges, to negative screening, positive screening, which to me is a increase in the knowledge and understanding of what I guess drives change and drives changes within the investment portfolio and kind of the risk and return profile, but also probably reflects that the speed of this transition is going to be relatively rapid in the next decade or two, and that kind of that tinkering around the sides is not going to set you up to I guess make opportunities out of that.
Leah, did you want to come in and?
Oh, I was just going to, sorry to go over you, Pip. I was just going to say, look, we already access opportunities, and I think New Zealand is really well set up from a renewable infrastructure point of view. I mean, you pointed out the agriculture, and no doubt biodiversity, nature disclosure, land use. It's one of our biggest areas that we're looking at the moment, and no doubt that's probably going to be the biggest issue for New Zealand to contend with in the coming years.
Lorenzo, from a global perspective, and I know when you're working with asset owners in New Zealand, are there specific things you're coming through around what's driving that change? Is it to meet legislative requirements? Is it from an investment perspective, and the robustness of the performance outcomes they're looking for? Is there a common thing that flows through from your customers?
Yeah, thanks, Dean. So, well, the report suggests consistent improvement in the quality of the responsible investment practices over time. And we think that is probably not directly attributable to one single factor. So probably, actually, it might have been driven by a combination of things. Things including good financial sense, a shift in investors' belief, and competitive pressures. So firstly, more and more investors believe that integrating financially material ESG factors into the investment research process is the right thing to do for their clients. ESG factors are increasingly essential inputs when actually you as an investor, you evaluate the global economies, the markets, the industries, and the business models of issuers that might enter your strategies, your portfolios. So by increasing, diversifying, by refining the information available to the portfolio management team, the investors like ourselves are able to get a more holistic, a more comprehensive view of any investment, which eventually benefits the end clients. Now, moving to the second point I was making on the investors' belief, it's quite clear that client demand has also been a catalyst for the evolution of responsible investing over time. And we are really witnessing a generational shift in mindsets. There is a rapidly increasing proportion of investors that are looking to align their financial aspirations with their sustainability objectives. And these elevated investor demand is, of course, subsequently pushing asset managers like PIMCO to improve their responsible investment strategies offered to the clients. And lastly, the point I wanted to make is that with the majority of the asset management industry offering some sort of responsible investment solution to clients to meet the client demand, the asset managers have to improve on the quality of their responsible investment practices to really stand out from the rest of the group, from the rest of the peers, in order to differentiate the offering, in order to ultimately capture the growing client demand. Asset managers probably will really continue to enhance, continue to bolster their responsible investment practices, and very probably develop a competitive edge in this space and across multiple asset classes. So that's how we see it playing over time.
Great, thank you, Lorenzo. Probably one of the big findings, and it's already come up a fair bit, is around that growth and stewardship and engagement. And I'd love to unpack that with each of you. We've seen in New Zealand, this is the first year that this has been identified as the #1 RI approach. We've also seen norms-based screening really explode, grew eightfold from not a lot to now clearly being the fourth most common and really catching up to those top three. What do you see is driving that in New Zealand, based on the people that you're talking to and what you're seeing in the market?
Shall I start first, Dean?
I'll start with Pip, and then I'll come back to you since you've already just had the mic.
Okay.
Patience.
Thanks. So in New Zealand, I guess some of the obvious drivers would be the stewardship code, which obviously has a big focus on engagement. I'd be interested in Lorenzo and Leah's view on this, but I think it's probably also a kind of global trend, but they can probably answer that better. The other obvious big driver, particularly of the norms-based screening, is probably the default KiwiSaver requirements and an increased focus then on on screening your portfolio for certain things. The other part, just maybe add in there, when we saw the results of the types of things that you're screening for in terms of the norms-based screening and where the big changes were, it was for things like TCFD, for instance. Now, that wasn't part of the questionnaire the year before, but also these things that we're screening on and that get classified under norms-based screening, I guess that they're improving. So these international standards and frameworks are increasing. They're getting increasing attention and they're becoming really, I guess, business as usual. So I would say that's also a big driver of lots of organisations now using TCFD screening as a bit of a baseline to assess whether or not a company understands its climate risks and opportunities, for instance. But interested in Leah and Lorenzo's views.
Yeah, thanks, Pip. And Leah, how do you guys see it from where you're looking?
Yeah, I think I've said it before, and I think to agree with Pip that climate-related disclosure, now nature-related disclosures, just that sort of overwhelming kind of global push for greater disclosure, not even just disclosure, but actual consideration of these sort of non-financial considerations when you're making investment decisions, and then being able to disclose on how you actually approach that is certainly driving this. But I also think that having done this for 30 years, stewardship, we have always seen as stewardship and engagement and advocacy are really key parts of being a responsible investment leader, because you can only invest so far. You can only make so much change and drive corporate behaviour when you're investing, and particularly if you're excluding large parts of the stock market like we do through our ethical charter. So I actually thought in preparation for today, we have a really well-developed stewardship policy and approach, which is it's disclosed on our website, and I just thought it might be of interest. I think these are really good examples. We think really strategically about systems level change, and so there's 4 key things that we have been really focusing on from a stewardship perspective over the last year or more, and I think it does point to the fact that you have to engage outside of your portfolio if you're going to actually drive systems level change. And the 4 key things for us was turning off finance for unsustainable expansion of fossil fuels, given the critical role that banks and finance, make in terms of us either making the transition or not rapidly enough. Land use, in particular, stopping livestock-driven deforestation and thinking about alternative protein sources and how we just rethink land use being one of the biggest issues for deforestation globally. And then reducing building sector emissions, critical as we have this, burgeoning middle classes right across the globe, industrialisation. So reducing the sector emissions from those building materials. And then the 4th one being advancing alternatives to animal research. So we've always had a really strong stance on animal research and not causing unnecessary harm to animals. But I do think as a community and as a society, that is, and it comes through in the consumer benchmark surveys every year as being a really critical issue for investors. And you saw things like whale meat come up on this year's survey, which I thought was super interesting.
Yeah, thanks, Leah. And Lorenzo, it'd be great to get your insights, because for us in New Zealand in particular, the stewardship and engagement piece is one that has been developing really quickly, but from a much lower base. And so, as Pip mentioned, we launched a stewardship code in New Zealand last year. The take-up of that has been fantastic, and we've had really great engagement. There was a really an industry-led initiative that's started to generate some really clear understanding of how we're going to report on stewardship and how we can formalise that in a way that's a lot easier for people to be able to decipher and a lot clearer for people to understand. How does that translate to the global perspective? Does this move to stewardship? Are you seeing that happen at a global level?
Yeah, we are actually not really surprised by the RIAA findings here. So when you think about the global space, if you look, for example, at the latest GSIA, the Global Sustainable Investment Alliance report, the stewardship and engagement strategy really ranks 3rd amongst the most commonly adopted strategies worldwide, just after ESG integration and exclusionary screenings. So to the question, how does engagement look like in bond space? Well, I would start with saying that our approach in sustainability strategies has always been more inclusionary than exclusionary. Reason for that is that we believe that collaborating with issuers, allocating capital towards issuers, willing, of course, those willing to improve their sustainability practices, well, that's something that can lead to a better outcome than simply excluding issuers with perhaps lagging sustainability metrics or ambition. So we typically go for a more active, hands-on engagement program, which we believe is key to encouraging, to supporting the change along the way. Now, when you think about the main objectives of an engagement program, well, our engagement activity is mostly focused on three main aspects. So first, encouraging positive change. Secondly, improving outcomes. And thirdly, reducing risks for our clients. We believe that engagement, so this collaboration with issuers, especially in the research phase, it's something that it's critical to better understand the risk and reward profile of the bond issuance that we're looking at, and ultimately make a better informed buy or sell decision. So that's how we think about it from an investment perspective. From a process perspective, we do have quite large bench of analysts, portfolio managers. These are the people that typically spend a significant amount of time meeting with senior management of the companies, of the investee companies, so the ones who invest in on behalf of our clients. And our portfolio managers, our analysts, in addition to discussing the typical financial matters such as cash flow generation, balance sheet management, profitability, for example, they also focus on a number of strategic issues that often relate to ESG risks, often relate to responsible business management practices. Now, if I wrap it up in terms of how in practice, so we talked at length about engagement in theory, but so in practice, how engagement looks like in the fixed income space. Well, when I think about last year, for example, we have collaborated with north of 1,300 issuers. We have deepened our conversations across a number of different themes, including climate change, of course, that's always very topical, but also other important matters like human capital, natural capital. And again, we did this to better assess the issuer's long-term resilience against these ESG risks. So we have, for example, engaged with companies on their climate ambitions, their climate goals, climate agenda, implementation plans, especially on methane emissions and emission reductions in the real economy. So that's on the climate side. We have also raised a number of questions about, in the context, of course, of these engagements, about effective, transparent, and inclusive human capital strategies meant for really improve on the talent retention side. And lastly, we have also deepened our understanding of the impact and dependencies on natural capital by these issuers.
Yeah, great. Thank you, Lorenzo. It's a really thorough overview. Really appreciate it. I guess when looking at all of these things, while a lot of them seem to be changing, and again, we talk about how critical they are, I think it's fair to say that all of this needs to be built on and based on some really strong performance returns, because at the end of the day, the vast majority of the investments that are being made and the vast majority of investors are investing for their own future and for a sustainable long-term future for themselves first. We actually saw some really interesting results this year. Performance was identified as one of the key drivers from asset managers behind the growth in responsible investment. But at the same time, obviously 2022, an incredibly unique year, a lot of volatility driven by energy crisis and what was going on in Ukraine and interest rates moving around. That saw RIAA certified funds underperform marginally over 1 year, but sort of hold over the medium to long term, which is terrific. But Leah, maybe it'd be great if you can unpack for us, I guess, what does that look like for you? You're operating in the market day to day with investors who have expectations on returns. How have you seen that market volatility play out? And I guess we're now, a long way through 2023. Have we already seen any kind of movement now that we've left some of that volatility behind us, or have we left that volatility behind us?
Yeah, thanks. And I think to put in context that I think it's really important that when we talk about responsible investing, we're not talking about we're not talking about ethics or values as opposed to financial or fiduciary duty. So as an investment manager, we always have a combination of the two, particularly as a deep ethical manager. Yes, the values alignment, the ethical charter that we apply is really important, but first and foremost, it's about delivering long-term, solid competitive returns to investors that can help them secure their future. So it's really important that it is a dual approach that we have applied for decades. But having said that, like any sort of active manager, I would suggest any responsible investment strategy is going to go through short-term periods of volatility. And 2022, we would have to admit, was a perfect storm for ESG or RI funds, including ours. And so we did struggle and were challenged with some short-term underperformance over the course of 2022. I think it's really important to understand what sort of drove that, and you pinpointed a little bit of that. I think every manager globally was challenged by the fact that we had global conflict, we had inflationary pressures, and we had, skyrocketing interest rates that we haven't seen in a number of decades. But in addition to that, the one thing that you mentioned was the energy crisis, and we saw fossil fuel companies, resources and commodities do particularly well and really benefit from that, particularly the global tension and demand for energy, and they're sectors that, as a deep ethical manager, we don't invest in. So being underweight or excluding those sectors did have an impact in the short term. We also had, I guess, a third leg to that, which was valuations in more growth-oriented sectors such as healthcare, IT, even renewables to some extent, the valuations were sort of challenged at different times throughout the year. And so we had to dig deep, we had to stick to our approach, and we had to evaluate, I guess, the value of staying excluded out of energy stocks and having that long-term perspective, the fact that we're driving capital to the right sort of more future-looking stocks and sectors. Disappointingly, we saw some, particularly global managers, reverse some of their positions in some of the energy stocks and go against sort of, I guess, the exclusions that they'd previously made. But we kind of stuck to our guns. And what we've seen through the last couple of months is a rebound. And we do tend to find that particularly resource cycles are quite sharp, quite short, and markets tend to rebound pretty strongly. And over the last 3 months, we've started to roll off some of that underperformance. And I just think it's always really important that any manager is going to have short-term periods of volatility, and it is the sort of the 3, 5, 10-year returns, the long-term returns that you need to stay focused on. And I guess the overlay of that is the risk of climate, the risk of stranded assets, the risk of devaluations in certain stocks that don't make that transition, particularly over the next 10 years.
Yeah, great. Thank you, Leah. I'm going to jump to some of the Q&A because we've had lots of questions, so really appreciate that. And by all means, keep them coming. We've still got a bit of time to answer some more. One that I'll throw out to anybody who cares to take it. We're seeing all of these pieces moving around. Do you think that the changes that we're experiencing at the moment are going to benefit larger investment managers and asset owners who have got the ability and the resources to build really strong, robust processes, or are they actually, does market conditions like this actually suit smaller operators better who are able to be quick and agile and make change in a landscape that is moving really rapidly? Happy for anybody to take that one.
I think I'll just quickly jump in, and I think, Pip, you've probably got a bit to add here, because in the discussions leading up to today, we did speak about the use of sort of ESG metrics, and that obviously was a really big part of the report, and there's no doubt that there is more managers across the globe using ESG considerations, but also using ESG ratings, I guess, to inform their decisions. And there is sort of almost like a commoditization of that happening at the moment. And so having proprietary teams, having internal research teams, having broader, deeper, an ability to look broader and deeper at ESG considerations in terms of a portfolio, we think is going to be a strength. And it goes to all the stuff that's talked about in terms of engagement and stewardship. They're much larger teams and they're much more qualified teams around the really critical issues. But I'm sure Pip has something to add.
I probably would just, I guess, agree with your comments, Leah, which is, and this was a bit of a discussion we did have earlier, which is around with this, I guess, this focus on greenwashing and as the standards. I think there was another question just about the difference between the TCFD and the New Zealand mandatory climate-related reporting regime. So as we see these kind of mandatory standards come in and the bar ratchet up, the focus really is on actually understanding the data and linking that back to actual kind of outcomes a lot more than things like ESG ratings that might be a bit of a black box that sits behind them. And so that's probably one of the kind of trends. I think one of the interesting survey results, which we haven't touched on again, was there was a really large increase in the number of respondents that use external ESG data. And you know, there is obviously a huge and increasing need for ESG data as these things become more important. But the trend is also that that you understand where that data is sourced from and what that data actually means and how it relates to actual outcomes. And that probably does mean, as you were saying, Leah, that potentially where you have the ability to have more resources specialized in this area to acquire, digest, interpret that information in-house will potentially become more important because the kind of black box approach is probably one of the things we're seeing. It is very much in the kind of the headlights at the moment as to what some of those ratings mean.
Yeah, great. Thank you, Pip. Lorenzo, I might come to you. We've got a question specifically about sovereign wealth funds, and New Zealand is a country that has sovereign wealth funds that make up a really sizable portion of the assets under management and have got a really active responsible investment and ethical investment lens and strategy as part of their approach. I know that PIMCO engages with a lot of different funds like that around the world. Are there trends that you see in sovereign wealth specifically on the issues that are important to them? Is it human rights? Is it climate? Is it all of those things? And are those trends different to asset owners generally because of the type of funds they are, or are they just like any other investment manager?
Thank you, Dean. So on that side, I would argue that climate change remains still very topical, even when you think about, Australia, New Zealand, and there are some differences here and there with respect to the global space. But the reality is clients in Australia and New Zealand, they are more and more thinking about the climate readiness of their portfolios. So that's a starting point. So how well their investments are prepared for pricing movements that are created by climate change. Now, the second step, this will be what we call, integrating financially material ESG factors in the investment process. What we're seeing from these clients is actually going even beyond that, even beyond the management, the mitigation of climate-related risks, and really seeking to start thinking about ways of decarbonizing their portfolios over time. So setting a portfolio decarbonization pathway target. So this is something that we are seeing, again, not simply in Australia, not simply in New Zealand, but more at a global level. And one thing that asset managers like PIMCO have been doing over the past few years is to look at the emerging standards, look at the industry standards out there in terms of, reasonable approaches to decarbonize bond portfolios, bond strategies. With that respect, actually, we have developed our own specific proprietary methodology that certainly takes into account the existing industry frameworks, and at the same time, tries to combine them as we see them, complementary, and eventually tries to take into account the specific characteristics of the underlying fixed income sectors in terms of carbon accounting, in terms of data availability and quality, in terms of the type of instruments that are available, such as green bonds, for example, or the levers that we have available to influence issuers. So these are all important aspects that we typically bring up with clients that intend to start their own decarbonization journey. Now, one important thing is that we don't believe necessarily that there is a one-size-fits-all approach on how to effectively implement a net zero portfolio decarbonization pathway. So, and at the same time, there can be no guarantee that a portfolio utilizing a net zero framework will achieve a net zero emissions alignment in the future. But the important thing there is that it's eventually up to the client, right? So it's eventually up to the client's preferences, the client expectations, level of ambition, and we're there to help them as stewards of our clients' capital to achieve these important sustainability objectives over time.
Great, thank you, Lorenzo. Question for Pip. I guess we are a couple of days, for better or worse, a couple of days away from a general election in New Zealand. What changes do you see happening as a part of that process? What opportunities potentially do you see that might exist? Is there anything that I guess we should really be looking for over, in particular this week, but also I guess in the weeks that are going to follow?
Thanks, Dean. It's a very common question. And I do have, I guess, a pretty standard answer to this question, which is, I guess, when we're talking about these issues, and I think this was mentioned before, if you look at the science that sits behind this, particularly on the environmental side, we now would know that we live in a world with planetary boundaries. We would know that we are exceeding those boundaries. Therefore, these issues are going to get worse. And climate change is one of them, but there are many of them, and they are all interrelated as well. So political cycles are 3 years. It's reasonably short. We know the science tells us it's going to get worse, so the gap is going to get bigger that we're looking to try and, I guess, just rectify. Now that's kind of the science behind this. So when I get asked about political cycles, I guess my answer is yes, there are ebbs and flows. I think Leah was talking before about the short-term return challenges. I guess my response is a little bit similar, that the underlying trend, the science would tell us that regulation is going to go one way over the longer term, because these issues are going to get worse, and therefore they're going to become increasingly social and environmental topics that we have to address. So the long-term trend, I think, is pretty clear. And I would also just highlight the Australian example. We've obviously had a bit of a period of time where ESG type regulation has gone probably backwards in Australia, and then you see that it's now back on the forefront with greater speed. Because as these issues get worse, people's votes do change towards parties that are looking to address these issues. So yes, we may see some volatility. Yes, there may be changes, but I would say that longer term trend is pretty clear and backed by scientific evidence. And that scientific evidence would tell us that these issues are going to get worse.
Leah, I might just come to you, because obviously you have been a part of an Australian landscape that has changed really quickly. How has that, or what have you observed having been part of that process? What kind of impact has it had on the industry in Australia that we might not easily or as easily see being on the other side of the ditch?
Yeah, thanks so much. And I think there's no doubt that ASIC has been probably a lot more heavy-handed, and it has actually publicly called out a number of large global managers, and quite prominent names in the Australian marketplace. But I think behind that, we're a proponent of responsible investing. We've been a long-term proponent of it, and so we do actually. We're encouraged to see the regulator actually focusing on efforts for clearer labels and to call out greenwashing, because I guess what we saw over the last couple of years in particular, as the momentum built around RI, as investors demanded more RI options, you had this proliferation of products coming to market, but you also had these marketing programs by pretty much everyone. I mean, green labels, ESG and RI credentials were all over marketing programs in the Australian marketplace, and we have definitely, anecdotally of course, but we have definitely seen a pullback of those programs. We've seen a lot of advertising and marketing programs pulled. We've also in fact seen a number of SRI options by major super funds actually pulled off the shelves. So we've seen a rollback, and that was really evident in the Australian report, where we saw some of the changes to how people were maybe, thinking about what they apply in terms of their approaches and their commitments versus their approach and things like that. And we saw a sort of a slight sort of pullback in terms of RI FUM in some respects. So I do think that managers are well aware that they have to stand behind their labels, that they have to have greater proof points, and they have to be able to really substantiate the intentionality and the outcome of what their labels are actually proposing to consumers. But ultimately, we think it's a good outcome, because we know that greenwashing is a major concern for both advisors and consumers. And better labels, better definitions, better agreed kind of taxonomies are only going to help consumers be able to sort of navigate the options with more confidence.
Thank you, Leah. Another question around, which speaks really interestingly to a bit of a movement away from simply managing out risk and looking at generating real-world impact through some of the responsible investment strategies that have come through. We've seen obviously continued growth in impact investing, as well as positive screening. Those continue to grow, but from an incredibly small base, still a much smaller proportion of the market than what they need to be in terms of meeting some of the challenges that we've got. But also really interesting, I think, when you compare this to some of the research that we've done in the New Zealand market specifically. RIAA and Mindful Money had a report that came out earlier this year. 66% of Kiwis expected that their KiwiSaver was having a positive impact on the world. Do you think that what we're seeing in this report translates to those outcomes starting to be delivered, or is there more work to be done? And if so, what kind of work do we need to be doing? I'm happy for any of you to jump in on that.
I might start again. So I think, and that was one of the points. I think one of the other things I really wanted to pull out of the report is that sort of impact investing part of the market, because I do think there is a little bit of a disconnect sometimes between what people perceive the impact they're going to be having through their investments and what they're really getting through their investments. And obviously, we've just spoken about regulation and greenwashing and all those things that will help try and sort of tidy that up a bit. But I think the other thing to be really cognizant of is there's only so much in terms of listed opportunities to really have an impact, to avoid harm, to try and find a more sustainable, positive solution. The listed markets, if you look at the Australian marketplace, is reasonably limited, and things like renewable energy are really still in infant stages without the sort of capital that we've just had sort of promised and committed to these sectors. We've been kind of standing still for a really long time. So I would say that impact investing still remains small, because it really is the domain of early stage sort of private equity, venture capital kind of investment. It's generally early stage infrastructure and technology. But I do think that the transition that we will have to undertake in Australia, but also globally, means, and that weight of capital will mean that there will be a certain tipping point of scale in these investments where they will become listed, they will become more accessible to retail investors. But at this point in time, we're probably looking at private markets exposure. They're probably going to be closed-ended. There's probably going to be lock-up periods. So you really are having to take a sort of a 5 to 10 year view of investing and wanting to have that impact through that lens of investing for that longer term period. But there will be a tipping point at some point where that impact investing gets a level of momentum and scale behind it.
Based on that, do you think we've got the settings right in KiwiSaver at the moment to allow the flow of capital into that kind of area based on the restrictions that Leah just highlighted, or is that something we need to continue to work on?
I think it's something that needs to be continued to work on. I think that this has come out many times and is a big challenge, which is the amount, the volume of assets that would meet kind of institutional investor requirements that are kind of positive outcomes is obviously small, and it also creates big barriers. I think there was another question about this as well, to kind of small, medium businesses as well, to access capital, even though they may obviously be purpose driven and helping to achieve certain outcomes. So definitely a barrier, and there is, I guess, initiatives underway to try and at least come up with some recommendations about things that could potentially help address those challenges.
And Lorenzo, I'd be interested to get your thoughts on this. Obviously, as a bond issuer, how in the fixed income space, how do positive outcomes actually exist in the space that you're investing in, and how do you look to quantify some of those outcomes?
Sure. So, well, I totally hear Leah's comments on the private side, but let me take the public debt side here. And really, we think that there are a number of different ways that bond investors can implement a sustainable investment strategy. So among others, first, I would say they can tap into the ESG label bond market, which is comprised of use of proceeds bonds, such as green bonds, social bonds, or sustainability bonds, that essentially devote 100% of their proceeds to financing positive environmental or social projects, such as renewable energy, clean transportation, affordable housing, and so on. There are also other instruments in this market, such as sustainability-linked bonds. The proceeds in this case are used for general purposes, but these instruments include a covenant linking the financing to a sustainability target, typically a coupon step-up. In practice, at PINCO, we have invested in green, in social bonds issued by major companies in a variety of different sectors, including, for example, real estate, financial sector. So to give you a couple of examples here, we have invested in the green bond of an integrated property development and construction company. That's a company that, from an issuer perspective, we consider as a climate leading issuer with a formal commitment to being a 1.5 degree Celsius aligned company. But when we look at the bond itself, the green bond net proceeds will be spent on a number of green building projects focusing on energy efficiency, low embodied carbon materials. So that's just one example on the green side. When I think about social bonds, for example, we invested in the social bond of a major US bank. The social bond seeks to finance the development of housing for low, moderate income populations. Seeks to finance mortgages for vulnerable populations. So these are just two examples, but importantly, we don't believe that the ESG label bond market is the only option for bond investors to implement a sustainable, comprehensive investment strategy. So with regards to climate-related opportunities, for example, we discussed the green bonds a moment ago, but investors can also tap into bonds issued by, for example, pure plays or climate leaders. So by pure plays, what we mean by that is essentially issuers that are fundamentally aligned to low carbon products and services, such as a renewable energy company that is not issuing, for example, a certified green bond. And on the climate leaders side, again, amazing part of the opportunity set. These are issuers that we deem to be at the forefront of the net zero carbon transition. They're leading their respective industries forward. They are issuers that have demonstrated a solid commitment to mitigating carbon emissions versus their peers. They're mitigating their broader environmental impact in sectors that may involve water, plastics, air pollution, or biodiversity, for example.
Really terrific. Thank you so much. Again, a really thorough background, which is great. Conscious of time, final question, 1 minute restriction to each of you. We do this every year, as I pointed out at the start. When you go back in decades, the advancements have been significant. What we're finding at the moment is each individual year, we are dealing with a totally different set of circumstances, which is just really, I think, speaks volumes to the speed of change that we're going through. We'll be back here again this time next year with another report. What do you think is going to be the single biggest trend that we're going to be seeing in the next 12 months? So if I could ask you to get your crystal ball out, 1 minute or under. Lorenzo, we'll start with you since you've got the mic. Okay,
I'll be brief. So there's no doubt that sustainable investing has gone through several evolutionary stages. Future trends also in sustainability, like in everything else, are quite difficult to anticipate. But among others, they increase, and I made a point before on this, the increased interest in decarbonization strategies has been noteworthy over the last couple of years. And we believe it has the potential to stay with us for the foreseeable future. More and more investors are starting to recognize that the climate implications. So they're starting to recognize that the importance of considering how well their portfolios are prepared for the energy transition. And beyond that, some investors, again, I spoke before, Australia and New Zealand, are starting to implement specific decarbonization strategies on their portfolios, namely strategies that seek to reduce their financed emissions over time. So hopefully, staying within the minute, that's how I would, end up my forecast for next year. So essentially, clients that will continue to embark on more and more ambitious decarbonization journeys going forward. Wonderful. Thank you, Lorenzo. Leah, I'll come to you.
Yeah, sure. I think there's probably going to be quite a common theme here, which is not surprising given the climate emergency that we're in. For me, it would be the net transition and that the rapid move that, particularly in Australia, but globally, we need to make, and the transition that companies will go through, and being on the right side of those investment opportunities, like who are the winners and losers, who's going to transition quickly enough, and be able to sort of, move their business model to be able to sort of address, and really net zero targets are not enough. It's the science-based approach. It's being able to make sure that business models and that scenario analysis of economies, sectors, companies is going to be really important.
Thank you, Leah. Zsuzsa, do you have a view? You obviously get a really unique look at all of the data that we're getting across all of our reports that we do. Do you have some thoughts on where we're likely to be in the next 12 months?
I think climate is going to continue to be a huge theme in New Zealand. In terms of disclosure, I'd like to see those ramp up. I'm hoping that we would see, so it's more of a wish than a future, or crystal ball gazing. More investment directed towards sustainable outcomes and improved reporting around engagement, particularly, I think. So I think those things, once the XRB and the regulatory requirement satisfaction pairs down, I think then we're going to start to see some other areas of the market develop.
Thank you, Zsuzsa. Pip, we'll end with you.
Outcomes. I think we'll see a trend towards measuring environmental and social outcomes of your portfolio in the next year. I guess I'm specifically talking about greenhouse gas emissions. It's obviously a requirement in year 2 of the mandatory reporting regime in New Zealand, so it's a pretty easy one to guess that we're going to see happen. But I think it's the start of a bigger bigger trend towards actually measuring the outcomes of companies that that are invested in.
Thank you so much, Pip. And thank you so much to each of you. That does bring us to time. Again, just wanted to say a massive thanks to the panelists who have given up their time. Lorenzo, I think it's coming up midnight in London. And also Leah, I know it was an early start for you this morning, so thank you so much. And Pip, as always, wonderful to have your contribution. And especially to Zhuzha, who works tirelessly on this throughout the year and has a huge amount of, or spends long hours poring over the data and communicating with members and making sure that we've got everything correct, and working alongside our research provider and our research partners. So thank you to each of you. And obviously, finally, a big thank you to those of you who have been a part of viewing this presentation, again, specifically and in particular, the members who contribute both to RIAA on an ongoing basis, but have also supplied so much of the data that allows us to draw out these insights. We really couldn't do it without you, and I just want to say thank you so much again. Have a wonderful afternoon. Aotearoa.